stop. Before you scroll past this video, I need you to hear something that Goldman Sachs said that almost nobody is talking about correctly. Over 100 pages. That's how long Goldman Sachs's biggest outlook report ever is, and within hours of its release, financial influencers had their thumbnails ready. Red arrows, screaming text, doom everywhere. There's just one problem. That is not what the report actually says. I spent a full week going through every single page of this report. I cross-referenced their data, fact-checked their charts, and I separated what Goldman Sachs actually predicts from what clickbait creators want you to believe they predict. And what I found? It's far more nuanced and far more useful than either the doom crowd or the permabulls want to admit. Today, I'm going to walk you through exactly what this report reveals, the specific risks, what it means for your money in 2026, and the decade ahead. Stay with me, because this changes your strategy. Let me start with what Goldman actually says about 2026, because this is where 90% of the coverage gets it completely wrong. Goldman Sachs titled their report, and I want you to notice this title, U.S. Resilience, Resilient. Not crash warning, not brace for impact, resilient. Their headline prediction for the S&P 500 in 2026, a 7% return, not a crash, not zero, 7% gain. Now let me show you how they get to that number, because the math here is actually fascinating. Goldman expects 11% growth coming from corporate earnings and dividend yields. American companies are still generating strong profits. The AI infrastructure build-out is driving spending. Consumer wallets remain open, solid fundamentals, but then Goldman subtracts 4 percentage points. Why? Because stocks are expensive right now. Goldman expects those inflated price-to-earnings ratios to gradually compress as valuations normalize. 11% growth minus 4% compression equals 7%. That's their base case. Below historical average, yes, but solidly positive. Not the collapse headlines screamed about. Goldman also put a number on recession risk. And this is where people freak out. They put it at approximately 25%. 25%. That means they see a 75% probability of continued economic expansion. Not a coin toss, not a sure thing. A reasonable background risk, not a prediction of imminent collapse. So why is everyone claiming Goldman predicted disaster? Let me explain exactly where that narrative comes from and why it's lazy at best, dishonest at worst. In October 2024, Goldman released a separate long-term forecast. And this one did generate alarming headlines because it predicted the S&P 500 would return only 3% annually over the next decade. 3%. That's barely above inflation. And crash merchants latched onto that number and ran with it, still running today. But here's what they conveniently left out. 1. The 3% figure was for the S&P 500 specifically, driven by concerns about market concentration and high valuations. 2. Goldman's global equity forecast was actually 7.7% annually, significantly higher. 3. And this is the most important part. Goldman explicitly states that low expected returns do not mean a crash is imminent. Markets can stay expensive for years while still generating positive returns. The path from overvalued to fairly valued doesn't require a cliff. It can happen through years of modest gains while earnings slowly catch up to prices. Goldman's own historical data proves this. In the 1990s, the market entered the 9th decile of valuations, meaning stocks were more expensive than 90% of all historical observations. What happened? The market rose. Another 342% before any correction. 2015 to 2017? Same story. 9th and 10th decile valuations. And the market gained 200% after that. Even through COVID, despite being in the 9th decile, the market gained another 100%. Goldman's own data shows that expensive markets can stay expensive and keep rising for extended periods. High valuations are a risk factor, not a crash trigger. Now, I'm not here to just reassure you. There are legitimate concerns in this report, and I want you to understand them honestly. Starting with valuations, the CAPE ratio, The cyclically adjusted price-to-earnings ratio, also called the Shiller PE, currently sits at 39 to 40. The historical average? About 17. We are at more than double the long-term norm. And here's the part that makes people nervous. This is only the second time in 155 years of market history that the CAPE has exceeded 40. The only other time? The dot-com bubble, 1999 to 2000. That comparison is understandably alarming. The dot-com crash erased trillions in wealth and took 13 years. 13 years to fully recover peak to peak. But, and this is a crucial but, Goldman argues the direct comparison is misleading. Here's why. Today's largest companies, Apple, Microsoft, Nvidia, Google, are highly profitable businesses with strong balance sheets, durable competitive advantages, and real free cash flow. The dot-com leaders were often unprofitable companies valued entirely on hope. That is a fundamentally different situation. Second, profit margins have structurally increased. American companies today generate higher margins partly because of the shift toward asset-light technology businesses. Higher margins can justify higher valuations. Goldman's position is nuanced. Valuations are a headwind for future returns, but not the dominant factor, and not a crash trigger. Here is what Goldman identifies as a more significant concern than most investors appreciate. And I promise you, most people have no idea this is happening inside their diversified portfolio. The top 10 stocks in the S&P 500 now represent over 40% of the entire index. This is the highest concentration level in recorded market history, higher even than the dot-com bubble peak. Think about what that means in real terms. If you own an S&P 500 index fund, which millions of Americans do, 40 cents of every dollar you have invested sits in just 10 companies. The other 490 companies share the remaining 60 cents. The Magnificent Seven, the dominant tech companies, alone account for about 35% of the entire index. Nvidia, a single company, represents nearly 7%. Goldman's research shows that historically, high concentration levels like this have been reliable predictors of lower forward returns and higher volatility. When an index is dominated by just a few names, its performance becomes dependent on those specific companies rather than the broader economy. Here's the scenario Goldman is worried about. Imagine AI spending disappoints expectations. The tech giants, who are investing hundreds of billions building AI infrastructure, represent an outsized slice of the index. A shift in AI sentiment could trigger selling across the entire market, even if most other companies are completely unaffected. Concentration doesn't cause crashes, but it amplifies whatever comes next, positive or negative. Today's market will move more violently in both directions than a properly diversified market would. Goldman actually suggests the equal-weight S&P 500 may outperform the standard index over the next decade. Removing that concentration effect could produce better risk-adjusted returns even if the largest companies keep performing well. You've made it to the halfway point, and you've already learned more about this report than 99% of people who saw those clickbait headlines. If this has been valuable to you, please don't forget to like this video, share it with someone who needs to hear this, and subscribe if you haven't already. Your support means everything to Tara and this channel. Now let's keep going, because the best part is still ahead. Real quick, hit that like button if this is already changing how you think about your money. Okay, back to it. Goldman doesn't stop at valuations and concentration. They identify 4 more risks most coverage completely ignored. Let me walk you through them quickly, because each one matters. Risk number 1, government debt. The U.S. debt-to-GDP ratio keeps climbing, and Goldman's projections show no reversal in sight. Rising debt means higher interest payments crowd out other government spending. More Treasury issuance competes with corporate borrowing, and at some point, investors may demand higher yields to hold U.S. debt, which raises rates across the entire economy. Goldman isn't predicting a debt crisis. They're identifying it as a persistent background risk, one that could trigger a sudden reassessment of U.S. creditworthiness if the wrong catalyst appears. Risk number 2, and this one shocked me, China's control of critical supply chains. China controls nearly 70% of rare earth mining, 92% of rare earth refining, and 94% of global magnet production. These materials are essential for electronics, electric vehicles, and defense applications, and pharmaceutical supply chains remain heavily dependent on Chinese ingredients. This dependency creates a vulnerability we've already seen flash in trade tensions, and it could escalate. Risk number 3, the Fed. Goldman describes the environment as mixed monetary policy. The Fed has started cutting rates, but the path forward is genuinely unclear. If inflation flares again and limits the Fed's ability to cut during a slowdown, markets that have been trained to expect a Fed rescue could be in for a rude awakening. Risk 4, political instability in various regions, banking stress in specific countries, our real estate problems in certain markets, all could create contagion effects even if America's core economy stays healthy. Here's what I found most valuable in the entire 100 pages, and it's the part that gets the least coverage. Goldman's investment philosophy section, their actual recommended playbook. Goldman outlines 5 pillars: history as a useful guide, appropriate diversification, value orientation, appropriate time horizon, and consistency. I know, that sounds incredibly boring compared to crash predictions and moonshot forecasts. But here's the thing. Goldman's research team, one of the most sophisticated in the world, builds their entire approach on these quiet, boring principles, and they back it up with data. Goldman includes a chart showing the devastating cost of trying to time the market. Since March 2009, staying fully invested produced almost 17% annual returns. But miss just the 10 best days? Returns drop to 12%. Miss the 25 best days? Returns get cut in half. Here's the brutal irony. The best days almost always happen during the most volatile periods, when you're most tempted to sell. The investor who panicked during COVID missed some of the strongest market days in history. The investor who fled during the 2022 decline missed the entire subsequent recovery. Goldman's message is simple but powerful. Trying to time market crashes destroys more wealth than the crashes themselves. That's not an opinion. That's 15 years of data. Goldman's report doesn't speak to one type of investor. It speaks very differently depending on where you are in life. So let me break this down specifically for you. If you're a long-term investor with a 20-plus year horizon, Goldman's message is actually the clearest. Stay invested. Don't try to time corrections. Expect that the next decade will likely produce lower returns than the last decade, but positive returns nonetheless. And consider diversifying beyond U.S. large-cap stocks to capture outperformance elsewhere. Medium-term investor, 7 to 15 years, Goldman's warnings deserve more attention for you. A decade of 6 to 7% returns instead of 13% returns means your portfolio grows significantly slower than you may have planned. Run updated projections. Consider whether you need to save more, work longer, or adjust expectations. Approaching retirement in the next 5 years? The concentration risk Goldman identifies matters significantly for you. A portfolio heavily weighted toward the S&P 500 index fund is actually a concentrated bet on just 10 companies. Consider whether that level of concentration matches your risk tolerance at this stage. If you're already retired and drawing from your portfolio, Goldman's forecast of lower but positive returns is actually relatively benign for you. Sequence of returns risk, the danger of being forced to sell during a downturn, is present, but Goldman isn't predicting the kind of severe crash that would catastrophically trigger that scenario. The bottom line? Your strategy should depend on your situation, not on a headline, not on a thumbnail, on your actual timeline and risk tolerance. Here's what I personally am doing after reading this report, because I think transparency matters. I'm not changing my long-term strategy based on valuation concerns. Goldman's own data shows expensive markets can stay expensive for years while still generating positive returns. The opportunity cost of sitting in cash waiting for a crash is historically brutal. Second, I am paying more attention to concentration. 40% of the index in 10 stocks concerns me, not because those companies are bad, but because it creates correlated risk I didn't fully appreciate before. I'm increasing my allocation to equal weight strategies and international markets. Third, I'm mentally extending my time horizon. If Goldman is right that the next decade produces 6 to 7% instead of 13%, I need to adjust expectations. But that's still positive compounding. Slower, but still working. Fourth, I'm maintaining slightly larger cash reserves than normal, not to time a crash, but to have the flexibility to rebalance opportunistically during volatile periods instead of being forced to sell. No drama, no panic, no dramatic repositioning based on misrepresented headlines. Before I let you go, I want to address the media machine that generated all these false crash headlines, because understanding it will protect your money far better than any single forecast. Fear generates clicks. A headline saying Goldman predicts a 7% return gets ignored. A headline saying Goldman warns of a crash gets millions of views. The incentive structure of financial media pushes toward catastrophizing every single time. This creates a persistent gap between what analysts actually say and what headlines claim they say. I've watched this repeat every year. Goldman's report is cautiously optimistic with detailed risk analysis. The coverage makes it sound like Armageddon. The solution is not to ignore risks. The risks are real. Valuations are high. Concentration is extreme. Debt is rising. Geopolitical tensions persist. But they're factors that reduce expected returns and increase volatility. They are not predictions of imminent collapse. Goldman's own chart shows cumulative returns since their 2021 outlook. The U.S. market has nearly doubled, up 99%. 5 years ago, they couldn't have predicted COVID, the inflation spike, the war in Ukraine, or the AI revolution. Yet staying invested produced extraordinary results despite all of that uncertainty. The next 5 years will bring surprises nobody currently anticipates. Some positive, some negative. And Goldman doesn't know what they'll be, neither does anyone else. But over long periods, staying invested in productive assets has generated wealth more reliably than trying to time disasters. The investors who will look back 5 years from now wondering why they panicked? They're watching crash content right now and preparing to make decisions they'll regret. The investors who will look back satisfied? They read carefully, understood the nuance, and stuck to their long-term plan. Goldman's report doesn't tell you the market will definitely go up. It tells you that despite real risks, the base case is continued positive growth, and the optimal strategy is consistent, long-term investment. That's not as exciting as a crash prediction, but it's what sophisticated analysts actually believe, and how they actually recommend you position. Before you go, I have a question for you. After everything we just covered, what's the one thing you're going to change or reconsider about your investment strategy? Drop it in the comments. I read every single one and I respond. This community is how we all get smarter together. If this video changed how you see Goldman's report, please like it, share it with one person who needs to see this, and subscribe so you never miss a video where I break down exactly what the big reports actually say. I'm Tara, and I'll see you in the next one.